So I wanted to start, Governor, with this issue of forward guidance. And one of the questions actually we've already touched on this morning was that the MPC minutes from February said, were the economy to evolve broadly in line with the February inflation report projections, monetary policy would need to be tightened somewhat earlier than anticipated at the time of the November report. Would you, with the benefit of hindsight, accept that that was a rather confusing statement about the future path of monetary policy?
No. Well, I listened to Dr. Valiga's testimony earlier, and as he said, effectively what that statement said was more likely to be 3 rate increases required over the course of the next few years than 2, first point. Second, if the economy evolved broadly in line with the committee's forecast, that would be required. And what happened was the economy did not, in the first quarter, evolve broadly in line with our forecast. Inflation came in lower, economic momentum, a number of signs were lower, and then ultimately the hard data came in lower as well. And we as a committee stepped back, looked at that data, and took our own assessments. Now, some of us were comfortable with raising interest rates at that May meeting. Others of us, myself included, thought it made sense to take a bit of time to see that the momentum that we expect as a committee in our forecast, the momentum in the economy to reestablish itself before raising interest rates. So,
well, we're going to come on, I think, to probably look at some of those potential factors. But the MPC often indicates that the likely path of interest rates, they base it on the forecast on market yield curves and then saying whether that yield curve is too high, too low, or just right. Again, do you think that process is understood by households and businesses as opposed to financial markets and journalists?
Well, I think that's why we give guidance such as limited and gradual, broad outlooks for the direction of interest rates and the potential quantum of interest rates, because, no, we would not expect households and businesses to check out the OIS curve, the Sonia curves, the movements in LIBOR volatility, etc. That's not reasonable. So we're trying to speak directly to people. I think people have been getting the message. There's ample evidence of that. And in terms of market volatility, yes, there will be times when the market is ahead of us in terms of anticipating changes in economic data, when to bring forward potential rate increases, when to push them back. And there are times when we might be a little ahead of the market. We might have a read of the data that is a bit ahead of the market. But to put this all into context, interest rate volatility today in short-term markets is very, very, very low relative to history, and it's very low relative to the degree of economic uncertainty. So there will be times when there's an adjustment as data comes in, but this is not a volatile market.